back to week 5, class 5 of 10. This week we're going to be covering covered calls. I know this was a very anticipated class. A lot of people were very interested in it. Jumping right into it, the agenda for today is just what are covered calls. We'll do covered calls versus normal calls, normal options. Why covered calls are better than dividends. We'll do some comparisons there. How to use covered calls. We'll do some live charting with that, and then we can do the Q&A and conclusion at the end. The live charting won't be TA based. It will be based on how you roll out covered calls, what you do to decide what strikes you want, so on and so forth. So first, we're going to go over what are calls. So most of us know it's if you think the price is going up, you buy calls, profit off the price going up. What calls actually are the right to they're the right but not obligation to buy 100 shares at the selected strike price. So for a standard call, what you do is you buy one contract for whatever the premium is. That contract gives you the right to buy 100 shares for the agreed upon strike price at the agreed upon expiration date. So looking to the chart to the right, you buy a $100 call for $200 on stock ABC. Your profit is unlimited because the stock can essentially go up forever. Obviously, it's not going to, but theoretically it can. Your max loss is $200, which is the amount of money, the total amount of money you purchased the call for. If, let's say, stock ABC closes at 105 by your expiration price, you are then able to buy 100 shares at $100, even though the stock is at 105. Although you put money up front for the premium, that increases what your average share buy is. So if you put $200 in for premium, the stock closes at 105. You buy the shares for $100 each, but you're really buying them for 102, including the premium that you paid for the contract. So now getting into what covered calls are. Covered calls are the right but not obligation to sell. So it's not buy, it's to sell 100 shares at the selected strike price. So you own 100 shares, you're leveraging your 100 shares. You sell one contract per 100 shares for an agreed upon premium at the agreed upon strike price. So the chart to the right's a little more messy than the other one, relatively the same idea. So stock ABC, you buy 100 shares at $100 each. You're all in for $10,000. You sell a June 1st $100 call. It's right at the money. You sell that for $5 or $500. That brings your break even on the shares down to 95 because you made $500 using the shares as leverage. So that brings your share cost average from $10,000 down to $9,500 because you made $500 using those shares. Point A on this chart represents where you bought the shares, and this line to the left is where your new break even is. So you're already in the profit as soon as you sell a covered call. Your downside's obviously unlimited. Your upside is capped by the strike price that you sold. So in this case, you have to sell those shares at 100 if stock ABC closes over 100 by June 1st in this example. If it closes under, you keep the premium and you also keep your 100 shares. So let's say you bought the stock for $100. It closes June 1st at $99.50. You lost $100 or you lost $50 on the shares. Unrealized, of course, but you collect $500 realized on the premium. So your green overall, your green realized profit, you don't have to sell the shares because there's no time frame on holding shares. The contracts expire and you get to capitalize on the theta decay, you get to capitalize on the IV crush, all those Greek values that option traders hate so much because they devalue the premium that you put in. If you sell covered calls, you get to collect that and you get to benefit off those premiums that you typically don't want to see if you're trading naked options. And now getting into why they're better than dividends, we'll first cover what dividends are. Dividends are the distribution of corporate profits to shareholders allocated on quarterly timeframes. These profits are taken directly from the share price. So if you buy stock ABC for $100 and the dividend is $2 annually, that means it's 50 cents quarterly. 50 cents from the share price gets taken out. So if you bought it for 100, it grows by, let's say, 5%. So it goes to 105 at the end of the year. 50 cents is taken out each quarter. So the first quarter, it will go from 100 down to 99.50. Second quarter, it will go down to 99, so on. The highest paying dividend is only 6.7% a year. That's not accounting for the increase or decrease in share price. So if you buy the stock for $100 and it decreases 10% over that year, you get a 6.7% dividend, but you're still down 3.3% on that year. To the right here are the highest two. It's VF Corporation, VFC, and Verizon. VF pays out 6.7% for the year. Verizon pays out 6.6%. These are the highest two dividends you'll get. There's nothing wrong with dividends, but you need to understand that if you want to make a decent amount of money on them, you need to have, for example, if you want to make $150,000 a year off dividends alone, and that's if the dividend stock stays perfectly flat for the entire year, you need to put in $2.5 million to make that $150,000. If you have a year like we did last year where all the stocks declined 10, 20%, yeah, you got 6% in dividends, but you're still down 15% overall in the year. So they do limit how much you're down, their passive income, because you collect them on quarterly basis, monthly basis in some cases. Overall, though, they're very, very low paying. The stocks move extremely slow because they're so stable. They're able to pay out those dividends each quarter. It's not a bad investment strategy. Covered calls are better than this, though, because they give you a higher yield. They give you a higher percent return each week. And you're also owning the equity. So it's not like you are using options to make money. You're using contracts and options to increase the amount of return you get. But at the same time, you're also owning shares. So it's not like you're decaying. You don't have to worry about selling them for a loss. You can hold them for as long as you want, just like you can with dividends. And the percent you get is often higher. And in some cases, on this example, in some cases, covered calls will yield you the same return in 1 week that dividends will yield you over the course of the entire year. So why are they better than dividends? The yield on covered calls on riskier names can be upwards of 8% per week. On safer names, it can yield upwards of 3%. If you go to extremely stable stocks like Ford, for example, that it barely moves, it pays out dividends, you get about 1/8% or 1% per week on your covered calls. It's still a decent amount. There's 52 weeks in a year. If you do it correctly, you can get 52% just off the dividend, just off the covered calls. Collect another 3% off the dividends from Ford. For covered calls, you're obviously free to raise and lower your risk. You have no restriction on what calls you can buy, which ones you can sell. So looking at the example to the right, this is one of my positions from 2 weeks ago on TQQ and Soxel. Reading this, I bought 1,000 shares of TQQ at $19.35 each. I sold 10. So if you remember, it's one contract per 100 shares. I sold 10 TQQ $20 covered calls expiring January 20th of 2023 for $71 each, collecting $710 in premium because I sold 10 contracts. TQQ closed over $20, so the shares that I bought at $19.35, you can see that right here, the smaller number, $19.35. I sell those shares at $20 a piece, so I make 65 cents a share, $650 there, and then I also keep the full premium, $710. I keep that. The reason that there's a mixture of red and green here, The calls, the higher the price goes, the calls increase. I'm not negative 250 on this position. This just means if I wanted to buy it back, instead of losing those shares, I would lose $250. Same with Soxal, I would lose $245 if I wanted to buy those shares back instead of get called on them. So you always have, and it's the same as with naked calls, you always have the option to execute it yourself. If you don't want to lose the shares, you can buy the call back for a loss. Same with calls. If you don't want to buy the 100 shares, you just sell the call for a gain. In this case, if I was not attached to the shares, so I was comfortable with getting called on them, I made $650 on TQQ shares. I made $710, total of $1360 off TQQ alone. My total all in, because I bought 1,000 shares at $19.35, my total in was $19,350. I made $1,360, so my return for that week was 7% of the overall position. And that equates the same as holding a dividend for the entire year and getting paid out those dividends. For Soxal, same thing. My all-in was $12,290. I sold a 12.5 covered call for $55 each, so I collected $550 in premium. I got called at 12.5, so I sold the shares for a $210 profit, 21 cents per share. So my all-in, again, was $12,290. I profited $550 off of the covered calls. I profited $210 off of the shares. 210 and 550 is 760. 760 divided by my all-in, which was $12,290. 6.2% gain on Soxal with a 7% gain on TQQ for that week. And that was over 7 days that I executed this. I didn't have to baby the charts. I didn't have to look at it every day like I was in options. Same thing that you would do with dividends. I don't expect that someone that buys a dividend at the beginning of the year is going to check that dividend 10 times a day, every day for the remainder of the year. You're going to look at it twice a day, maybe once or twice a week, set it and forget it, and then you make your money. So how to roll out covered calls, the steps here. You search your desired ticker, and I'm doing all this on Webull because that's the brokerage I use. Search your desired ticker. You want to go ahead and buy, in this example, this is ticker SOXL. You want to buy 100 shares per covered call that you wish to roll out. 100 share increments, you can't have any more, you can't have any less. 101 shares, you're going to be able to roll out one covered call. 201 shares, two covered calls. 199 shares, one covered call. So it needs to be 100 share increments. Navigate to where you typically buy options. Act as if you were buying a call, but instead of buying it, you click sell. So in this case, it was a $16 Soxal covered call for February 24th of 2023. You click sell instead of buy. You collect $51 in premium. So you're credited $51 in premium per covered call that you sell. You sell one contract per 100 shares. If at expiration your strike price is above, or your share price is above the strike price that you sold, you keep the premium and you also sell the shares for a gain. Something that you always want to remember too is with covered calls, you always want to sell a strike price above what you paid for those covered calls. You never want to sell a strike price below what you paid. So if you bought 100 shares of Tesla at $200 a piece, you want to sell a strike price greater than or equal to 200. You never want to sell a strike price that's below 200. If you buy those shares for $200 and you sell a $195 strike, you're already putting yourself at a $5 loss per share, $500 on Tesla per 100 shares. If you think the market's going down, you're better off to just sell an at the money or slightly above the money covered call, or just sell a typical covered call, $204, $205 covered call, and either leverage yourself with puts or you can sell the shares if you think the market's going down. Whatever you want to do to minimize your losses, this is the method that you would use if you were rolling out covered calls. So once completed, your holdings should look a little something like this, and this is that same example from earlier. You should have a covered stock, and this means that you own the shares, but you are leveraging your options to, and this is where cover the stock means, or comes from. You're covered because you're leveraging yourself to the downside. So the outcomes for covered calls, there's 3 of them. Outcome 1, you buy 100 shares of stock ABC for $10 each. Your all-in is $1,000. You sell an $11 call, a weekly call, for $50 in premium. Stock ABC closes on your expiration over $11. You can sell the 100 shares, or you can buy the call back for a loss, like I said earlier. Typically, what you're going to do is you sell the 100 shares at $11 each. You bought them for $1 each. You make $1 per share. That's $100. This is supposed to be 50. Excuse me there. I don't know why I put 56. You can sell those 100 shares at $11. That's $1 profit per share. $100 profit there, and you get to keep the premium. So your profit for the week is $150 off of $1,000 put in. Outcome number 2 is you buy the same stock, do the same covered call. ABC closes below $11, so let's say it closes at $10.50. You keep the full premium and you keep your 100 shares, so your realized profit for the week is $50. You also get to keep your shares. If they're at $10.50, you're unrealized up $50, 50 cents per share. And you get to roll out another covered call for the following week. And outcome 3, which is the one that everyone asks, what's the downside to covered calls? There's got to be something wrong with them. It seems like I can't lose. Outcome number 3, you buy 100 shares of the stock. Same method, ABC for $10, costing $1,000. You sell $11 call for $50 in premium. So let's say you bought it for $10. ABC closes at $9 on your expiration. So you're down unrealized $100 on your shares. So, oh no, my shares are down 10%. What am I going to do? Remember, they're shares. You don't have to sell them for a loss. You can hold them for as long as you want. But because you sold your premium, or you sold an $11 call, I messed the math up on this. I apologize for that. Because you sold an $11 call for $50 profit, without putting more money in, you made money off those shares. That subsequently lowers your average price on those shares. So you bought them for $10, you made $50 on the premium. That lowers your dollar cost average on those shares down to $9.50. So for the following week, you can sell a $9.50 or a $10 covered call. So in this case, let's say you sell a $9.50 covered call for the following week. Your realized profit for that week is $50. You still have your shares, and you rolled out another covered call for the following week. So the downside is, and this is what everyone asks me, the downside is if a stock falls extremely fast to the point that your downside protection is overachieved. And by that, I mean, if you buy, and I'll go back to this slide, and this is what the covered stock means. I bought those 100 shares of TQQ at $19.35, and I made $71 per 100 shares. That lowered my price. That lowered my average cost on those shares down to $18.64, which you can see here. So my downside protection is 7% or 6% below what I already paid for those shares. If the downside protection is broken within the week that I sell those covered calls, or you can do this on weekly, monthly, yearly, whatever time frame you want. The longer the time frame, the longer you're going to have to sit on the money, so keep that in mind. If this breaks my downside protection within the week, then that's when I'm red. So in this case, let's say TQQ, I bought it at 1935. My downside protection is to 1864. Let's say that TQQ closed that week at 1850. I'm going to be down 14 cents per share unrealized. But because my average price is 1864, I could sell a $19 covered call, even though I paid $19.35 for the shares. I can sell a $19 covered call for, let's say, $60. That would lower my dollar cost average from 1864 down to 1804. So I'm putting myself in the green, even though I'm down on the shares from where I purchased it, because I'm using those shares to leverage options on them. I'm collecting premium from those options that I'm selling. Eventually, and you could do this without doing any TA at all, eventually there's going to be a green week, there's going to be a pullback where I get called on these options and I'm not going to be in the red. And that just delays the weeks that I take profit. That's the method that I roll out. That's the method that I've been teaching. What I do is I buy the shares each week. I sell a covered call. I assign my downside protection. In this case, it was 1864. If it's over my strike price by the expiration, I sell the shares and I keep the premium. So I kind of double dip in profit in that sense. If it's below the strike price, I keep the premium. And then if it's below my downside protection, I'm unrealized red, but I keep the shares because there's no time frame. I don't have to sell the shares for a loss. The shares don't decay. I don't have to worry about the shares disappearing. And I roll these out on stocks like TQQQ, Soxel that are leveraged to the NASDAQ, to semiconductors, very stable stocks. Yes, they do move up and down, but they almost 100% won't get delisted because it's connected to major companies in the NASDAQ. So yes, you can lose on these. Theoretically, though, you can't lose because you can roll out covered calls indefinitely until you're green. In this case, my profit for the week, as I previously stated, was 7%. I can roll those out week after week. So say we continue going down. I roll those out week after week until we do have a pullback week. That's where I take my profit. So that's the downside to this. You're not going to have a green week every single week. You're not going to have a 100% win rate. No one's going to have a 100% win rate. What you're doing with this method is you're leveraging your downside. You're leveraging your shares to protect your downside. At the cost of that leverage, you're restricting how much profit you can make. So that's the trade-off here. Yes, I bought the shares at $19.35. I sold a $20 call. Say TQQ goes to $25. I still have to sell those shares at $20 a share. So I don't get to capitalize on that $5,000 move up for these 1,000 shares. I'm still green. I still collect money. I just miss out on that move, that large move to the upside. On the other side, if TQQ goes down $5, I'm protected down below where I bought the shares as soon as I sell that covered call. I continue selling covered calls above what my share dollar cost average is. So like I said, $19.35 is what I paid, collected $71 off that premium. That lowers my share cost average down to $18.64. As long as I sell a strike price that's above $18.64, I'm going to profit. Now, what happens if we have a market crash and my shares go from 19 all the way down to 10 in 1 week? In this case, what I do, and this is the investing strategy that I do, I don't deploy all the money that I have. I have 50% of my overall position. So these positions, about 30,000, 31,000. I have $16,000 in buying power that I can use to average back into these positions that will lower my dollar cost average on those shares. So I will essentially double down on both positions if we had a market crash. I'll continue selling covered calls until we do have a green week, and then that's when I secure my profit. So there might be months where you're 4 for 4 each week you make your 1,300 or 7%, whatever you put in. At the same time, there may be months where you miss all 4 weeks if you're new to this, or if you just have a bad streak. There will be months where you miss all 4 weeks, but remember, you don't have to sell those shares for a loss. You can hold them until they come back, or you can continue selling covered calls until you're green. Go back to how you select which option to sell. Here you go. So there is downside to it, just like anything else, but the benefit is that you get to hold shares. You're not holding options that decay. You're holding shares that you can have for 10, 20, 50 years, however long you want those shares. You can hold them indefinitely. You don't have to sell them for a loss. And you can use these covered calls to leverage yourself to protect your downside. At the same time, you're getting a steady stream of income each week, every other week, every other 3 weeks, every other 4 weeks, however long it takes you to get that profit. That's your steady stream of income. So there's minimal downside to these covered calls. There is downside. It's not 100% green all the time, rainbows and butterflies. There will be some times where you'll be down overall. All you have to do is exchange time for money. Just like anything else, if you're down on your shares by $5 a share, you don't have to sell them for a loss. You just have to wait a week, 2 weeks, 3 weeks for those shares to recoup that loss back up. The market cycles in different ways. Again, the stocks that I trade are leveraged to the NASDAQ. They're leveraged to stable companies like semiconductors, all the companies in the NASDAQ, SPY, whatever stock you want to trade. As long as it's secure and it's not going to get delisted, you theoretically cannot lose on covered calls. And then we can get into these brokerages to use. So on the left here, we have the ones that I circled in green. These are probably the easiest 3 to use. TD Ameritrade's kind of in a little gray area where if you know what you're doing, you can be pretty easy going on the rolling out of those covered calls. Webull and Robinhood are definitely the 2 easiest. On the blue side, we got Interactive Brokers, Charles Schwab, Fidelity, Thinkorswim. Unless you absolutely know what you're doing, these are pretty difficult to roll covered calls out on. This is just my opinion. I think that it's overly complicated compared to Webull or Robinhood. As much as I hate Robinhood, they have a very good UI for rolling out covered calls, so doesn't Webull. TD is a little bit complicated. I'm sure it's easier if you know everything, know all the loops. If you know everything you're doing, it's going to be easier, obviously. If not, it's going to be difficult at first, so I recommend getting used to at least Webull or Robinhood. The brokerage is on the right here in the blue. Personally, I would not even touch with covered calls. I would rather put my money in Webull. Honestly, I would rather put my money in Robinhood than use those ones because of how complicated they are. So that concludes it for the slideshow, and then I can go and show some TA on how I personally get into covered calls. So this is just the chart of Soxel here. All I do is use basic TA, and this is from class 2, the channels and trends. I use very, very basic TA on macro time frames. You never want to, I don't roll out covered calls in 5-minute or 15-minute. I don't use anything under the 4-hour time frame. What I do is I just go into the daily chart, sometimes even the weekly chart, and I will look for either channels like this. I'll look for bounces off key levels. I'll look for whatever TA strategy I want to use, but let's stick to the one we covered in class 2, covered channels and trends. So what I have here is a larger macro trend. I have an ascending trend on Soxel, as well as a bull flag here. So what I'm expecting is a bounce on Soxel from 1540 up to 1725. This is the shorter term channel. Ultimately, it could follow this larger channel and go all the way down to $12. So let's say I currently have shares at 16, $17. If it goes all the way down to 12, I'm going to be down $5 a share. It's going to be 33% of the position I'm down. Depending on how long it takes to get down there, I'm going to continuously roll out covered calls until I'm green on that position. Currently, in the Discord, I have rolled out, I believe, 4 covered calls where I've bought them back for green and sold more for the following week. And I've lowered my average from 17 all the way down to about $14. It might even be into the 13s now. So if we do fall for another 2 weeks, those 2 weeks of covered calls should lower my average to about 11, maybe 11.50, and I'll be green even if we get all the way down to this $12 mark. So this is how I assess buying those covered calls. What I want to do is I want to buy the shares at lows and I want to sell the shares at highs. Pretty basic market strategy. I think everyone's heard it. Buy low, sell high. You don't want to be buying the shares at highs. If you do, it's not the end of the world. I made the mistake of buying shares at 17 on Soxal. So I bought the shares right here. I've used covered calls, leveraged myself, protected myself to the downside. In doing so, I've protected myself all the way down to about $13.80, $14 a share. So if we do continue to go down, I'm not going to be too red because I've used covered calls to my advantage. I will be unrealized red on the shares, but I'm exchanging time for money. I'm going to exchange some time. I'm going to say, I don't mind holding these shares for another month. If it takes Soxal another month to reach 17 again, so be it. That will be when I secure those profits. If not, if we go up to 17 next week, great. Then I'm going to make $1,400, $1,500 or about 6 to 7% of what I put into that position. And this is the same method I do for any stock that I want to roll covered calls on. The other one is TQQQ. Same thing. Look for channels and trends on this, significant levels, whatever you want on the macro time frame only. You don't want to be doing this on the 5 to 15 minute. So here, looks like we have another bull flag. I'm expecting TQQ to bounce up to probably 25, 26 next week. I could buy shares here and sell. So TQQ is at 24 flat right now. I could buy shares here at 24, sell a 24.5 covered call for next week. The premium on that covered call is likely going to be $60 to $70. I collect $60 to $70 per 100 shares. So say I bought 100 shares of TQQ right now. I'm going to be all in for $2,400. I sell a 24.5 covered call for next week, 7 days away, for $60. I collect $60 on these shares. That instantly lowers my dollar cost average down to $23.40. If TQQ is above $24.50 by next week's expiration, I have to sell those 100 shares at $24.50, so I make 50 cents per share, $50, and I also keep the $60 that I sold the premium for, or sold the contract for, all in profit. Or my all-in was $2,400. My total profit was $110. So 110 divided by 2,400. My profit for that week is 4.6% of what I put in. Some weeks are going to be higher, some weeks are going to be lower. The gist of it, the range, I would say, is about 3 to 8% on moderately risky stocks. Stocks like Ford, as I previously said, this thing moves maybe $2, $3 a year. Your premium that you're going to collect on this is going to be probably about 0.5 to 1% per week. Might be a little more, might be a little less, but not much. It's going to be safe, obviously. If you roll this out for the entire year, you're going to be 54% if you get a percent per week, or 52%, excuse me. If you miss some weeks, you're likely going to be in the range of 30 to 40%, and that's 30 to 40% of what you put into this position for the entirety of the year. So let's say I'm going to go back to Soxal and use this as an example. Let's say on January 6th of this year, or January 1st of this year, I bought $100,000 worth of Soxel, or what's that, 10,000 shares. So my all-in will be 10,000 shares at $9.10 a share, $91,000. I can sell 100 covered calls a week, whatever the premium is. I don't have to sell those shares for a loss. So say I did buy those 10,000 shares at $9.10. If I just held them the entire time, I would make almost 100% of what I put in, or 91,000. If I sell covered calls, yeah, I'm going to make less money than if I just held the shares the entire time, but I'm protecting my downside if we didn't go up. Hindsight 2020 on this, that we did continuously go up for the whole first month of this year. But if we had gone down and I sold covered calls, I protect myself to the downside. I don't have to sell the shares. I keep the shares, keep the premium that I sell or sold those contracts for. Protect myself if we go down. I'm green if we go up. That's the gist of it. And that will end this week's class. Next week, I believe we're going over either Heikin-Ashi candles. Let me look real quick. Just a second. So next week, we'll be covering options flow and volume. The week after, candlestick patterns. The week after that, Heikin-Ashi, swinging plays, and then the final class will be IV strategy. So that will conclude it for this week. No homework, just because covered calls are more so an active thing. It's not something that you can look into or practice. It's really just the TA that you need to get down, and then it's buying shares. That's about it. But that will end the recording for this time. I will see you guys next week.